Hello, welcome to my channel. In this video, I'm going to explain the difference and similarities between LLSP, Lira, and LLSP. In the beginning of this year, I quit my job at Thales and I had to transfer my pension from the Thales pension plan to a locked-in RSP. Unfortunately, my investments was out of the market for almost 2 months because there was an issue with the transfer. My bank thought the transfer was to an RRSP, while it should have been to a locked-in RSP. My money was just being kept at the bank for almost 2 months without even earning interest income.
I'm not going to talk about RRSP in detail. If you're interested in learning about RRSPs, you can watch my other video. The link is in the description. A locked-in retirement account, LIRA, is basically the same as locked-in retirement savings plan, LRSP. They are investment accounts for holding locked-in pension funds. The main difference is LIRAs are provincially regulated, while LRSPs are federally regulated. For example, I was working in the telecommunications industry and my pension plan was federally regulated. So, what are the similarities and difference? First, you can make contributions to your RRSP, but you cannot make contributions to LIRA or LRSP. Money can only be transferred from company pension plans into LIRA and LRSP. Second, you can generally withdraw money from your RRSP at any time with tax consequences. However, money in LIRA and LRSP has to stay in the plan until you reach retirement age. There are some exceptions, such as non-residency, reduced life expectancy, and financial hardship. Another key difference is that RRSP is eligible for home buyers plan and the lifelong learning plan, while LIRA and LRSP are not eligible. In terms of similarity, any income you earn in RRSP, LIRA, or LRSP is usually exempt from tax as long as the money remains in the plan. For this video, I'm going to focus on the defined contribution pension plan because the transfer for defined benefit pension plans are not as straightforward. Nowadays, most employers only provide defined contribution pension plans because defined benefit pension plans are much more expensive. When you leave an employer and you have not reached retirement age, you may have to transfer your pension to another plan. You may be able to stay with the current provider, but you should review the terms and conditions and look at the investment options and administrative fees. You need to evaluate the pros and cons. For example, if you stay with the current provider, you may be required to pay a higher administrative fee as you are no longer in the company plan. A defined contribution pension can be transferred to a locked-in retirement account or locked-in retirement savings plan. Again, this depends on whether your defined contribution pension plan is provincially or federally regulated. If you are not sure, you should talk to your employer or pension plan administrator. I've also included a link to the OSFI website in the description, which you can use to search for the list of federally regulated pension plans. Most pension plans are actually regulated provincially. When you transfer your defined contribution pension to a LIRA or LRSP, there will be no tax consequences. To initiate the transfer, you need to open a LIRA or LRSP. Then you need to complete a transfer form. Your financial advisor should be able to help you with the paperwork. In addition to the transfer form, you will also need to fill in a T2151 form and provide information such as the plan registration number and CRA registration number. If you're not sure about the detail, you should check with your pension plan administrator. I would recommend gathering as much information as possible before leaving your employer. After you complete the transfer request, please ensure you follow up with your financial institution regularly. Thank you so much for watching this video. If you have any questions, please leave me a comment.